Today is Monday, September 15th, and this is the ADM Investor Services Weekly Market Kickoff. Please note that the views and opinions expressed here today are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or ADM. Today's guests are Mark Soderberg, Mark Bowman, and JP Steiner, all from the ADMIS research team. Starting with the grains this morning, Mark Soderberg, any surprises from Friday's USDA reports?
Yeah, to me, the biggest surprises again came in the acreage data. The USDA found another 1.47 million acres of corn that were planted, and they raised their harvested acreage figure 1.356 million from last month. With the harvest acreage now just over 90 million acres, I believe this to be an all-time record here in the U.S. While they cut yields 2.1 bushels an acre to 186.7. It's still a record high and resulted in production being raised 72 million bushels to 16.814 billion. That was roughly 300 million bushels above expectations. Perhaps even more surprising, however, was the fact that the market's reaction on Friday, closing 10 higher. Although ending stocks, they held just above 2.1 billion bushels, roughly 100 million above expectations. I think the market viewed the bullish enthusiasm, given the fact that the ending stocks weren't raised more because they raised the exports 100 million bushels. No surprises on the soybean side, with production and stocks pretty much coming in very close to market expectations. However, the USDA also here found another 200,000 soybean acres. To me, the market's reaction would suggest that traders are expecting lower production figures in future USDA reports. Since 1990, I've found 8 years where the USDA raised corn yields in the month of August, only to turn around and lower them here in September. In 5 of those years, final yields were below that September forecast, with 3 years being above. On years that they lowered them by over 5 bushels an acre. So I'm leaning towards lower production down the road in corn. And in beans, only 2 years I could find where yields were raised in August, lowered in September, and in both times yields ended up being below what that September forecast was by an average of just over 1 bushel an acre.
And Mark, despite the lack of a trade deal with China, do you feel the lows are in for the soybean market?
Yeah, I think much has been made this entire growing season over the lack of a trade deal with China, and obviously concerning. However, as we discussed a little bit last week, I haven't been as concerned as most for the 25-26 growing season. The market, the USDA did lower their export forecast by 20 million bushels in Friday's report to 1.685 billion. But when you look at the global balance sheet, they still have Brazil exporting 112 million metric tons. China importing that exact same amount. So I think just the more China buys from Brazil, the less they can sell to everyone else, present opportunities for the U.S. to pick up some market share there. But yeah, who knows? Maybe a trade deal can still be reached. The U.S. and Chinese trade delegates are speaking again in Madrid this week, and hopefully laying the groundwork for President Trump meeting with President Xi sometime this fall, likely in late October. So I think Nov beans right now, they're going to go up and challenge this recent high at 1062 3/4, possibly even the June high at 1074 with this much lower acreage base. I think we've raised that floor significantly. So I think the lows are in. Also, I think worth keeping an eye on is that Brazilian real. That's jumped out now to a 15-month high, just as Brazil is heading to the fields to plant their 25-26 corn and soybean crops.
Thank you, Mark. Mark Bowman, how's the Brazilian sugar crop looking?
Well, we should get a better idea after the Unica report was released, and that should come any day now. Usually it's done by the 15th of the month. This report will cover the second half of August. When we look at mostly at production in the center-south region, which is the main producing area of Brazil, Brazil also being the largest producer in the world. So it is important to get a grip on this for the whole world sugar outlook. Now, we've seen sugar production improve substantially since the beginning of their marketing year, which began on April 1st. They're gradually catching up to last year. First half August production was about 3.6 million tons, which is up 16% from the same period last year. Trade expectations now centering around maybe 3.8 million for the second half of August, which would be up 17% from a year ago. And cumulative production as of mid-August was down 4.7% from last year. That was an improvement from mid-July when they were down 9.2%, and in mid-June when they were down 14.7%. We've seen dry conditions this summer have been conducive to harvest. The remaining question is how much damage was caused by last year's drought, but at least the trend in production since June suggests the damage was less than feared.
And Mark, let's shift to the crude oil market. Where do U.S. crude oil supply and exports stand currently?
Okay, so the last EIA stocks report, the weekly stocks report, showed crude stocks at around 424.6 million barrels, which is up from 419.1 million a year ago, but still below the 4-year average of 423.3. So there's around the middle of the range of the last 4 years. We leave the COVID year 2020 out, which had an exceptionally high 500 million barrels. Crude stocks have a seasonal tendency to bottom out around mid-September, but this year that seems to be ahead of schedule. They put a big low in mid-June. So supply coming back. Refinery runs reached a record high, at least in the last 6 years, of 96.6% on August 1st. And they've started to ease back as low as 93.3% a few weeks later. This is still a 6-year high, though. And this above average rate has been keeping crude oil usage firm and helping keep stocks low. The other aspect is U.S. exports. The 4-week average for U.S. crude oil exports fell to 3.1 million barrels per day in mid-July versus 4.1 million a year prior and a 4-year average of 3.6 million. So they fell off sharply then. That was the lowest for that date since the COVID year in 2020. We've since made our way back to 3.7, which is close to a year ago in the 5-year levels. And this will be worth watching to see if the increases in OPEC plus production start to cut into U.S. exporters. U.S. is still a net importer, by the way, but it's these exports that kind of bear watching because of the competition with OPEC plus. And OPEC plus has already fully unwound one tranche of their 2.5 million barrel production cuts they enacted a couple of years ago. And they started doing that in April. They've already started to work on a second tranche more than a year ahead of schedule.
Thanks, Mark. JP, the Fed is meeting this week. What's to expect? And the Bank of Japan and Bank of England also having policy meetings. Can you touch on those as well?
This week's central bank meetings are set against a backdrop of diverging economic conditions and policy priorities across those major economies. The Fed is widely expected to resume rate cuts on Wednesday, likely lowering the target federal funds rate by 25 basis points in a move that really shouldn't surprise anyone given the growing concern over the labor market and recent data showing a sharp slowdown in job creation and a slight uptick in unemployment. Inflation remains above target, but so far hasn't surged by as much as economists have been worrying as a result of tariffs. But given the inflation picture and the weakening labor market, policymakers appear willing to prioritize employment support. Fed fund futures show traders are fully priced in for a rate cut. Again, really not a surprise, but are also pricing in an 82% chance of another cut in October and nearly a 75% chance of another cut in December. In regards to what to watch for, markets will monitor comments from Powell and the Fed's updated summary of economic projections to see if inflation and labor market dynamics have shifted Fed guidance any looser. Any surprise in expectations as to the pace and scale of easing could see yields react sharply. Meanwhile, the Bank of England is expected to hold rates steady on Thursday. That's following a rate cut back in August. Despite signs of economic fragility, persistent inflation, especially in services and wages, has kept policymakers at the Bank of England cautious. Upcoming UK jobs and CPI data will be pivotal, but for now, the Bank of England is likely to maintain a wait-and-see stance, with markets pushing expectations for the next rate cut into early 2026. The decision will also include updates on quantitative tightening from the Bank of England as the bank there considers slowing its pace of sovereign bond sales. Over in Japan, the bank there is expected to keep rates unchanged at 0.5% at the conclusion of its two-day meeting on Friday. The Bank of Japan is actually in a situation where it is actually looking to hike interest rates, sort of policy normalization over there. Despite sticky inflation and signs of economic resilience there, political uncertainty following Prime Minister Ishiba's resignation earlier last month has added complexity to the outlook, especially when it comes to the policy outlook from the Bank of Japan. The bank there remaining cautious but is under pressure to normalize policy. Core inflation has stayed above target, and trade headwinds have eased slightly following the trade deal with the U.S., so a hike could come later this year depending on wage trends and data out for the October Tonkin survey. Markets are going to be looking for any signs on when to expect a rate cut from the Bank of Japan.
Lastly, JP, what did last week's CPI inflation tell us?
Yeah, last week's CPI inflation for August came just days after a weak jobs report, which had showed only 22,000 new jobs added and a rise in unemployment. Regarding the CPI data, the data did show that price pressures were accelerating modestly, but not surging. That was a huge fear that many economists initially had as a result of tariffs, but so far we're seeing that price pressure increases have been modest, at least for now. Headline inflation rose 0.4% in August, ending at 2.9% on a year-over-year basis, both higher than July's readings, although in line with expectations. Core inflation remains steady at 0.3% monthly and 3.1% annually, showing persistent underlying inflation pressures. Shelter and food were the primary drivers. Notable increases in rent, groceries, dining out as well contributed to the price increase, while energy prices rose just slightly due to a rebound in gasoline. However, before the CPI figures came out, PPI inflation figures for August showed that producer prices actually fell 0.1% in August. That's following a 0.7% increase in July and a 0.1% increase in June. That monthly decrease was driven by a 0.2% drop in final demand services, particularly a 1.7% decline in trade service margins, with machinery and vehicle and wholesaling margins falling 3.9%. Core PPI, excluding food and energy and trade services, rose 0.3% in August and 2.8% over the past year. That marked the largest annual increase since March 2025. Ultimately, both readings telling us that core inflation pressures remain, especially in services and core goods, which could be a factor that impacts the pace and scale of rate cuts this year, although the Fed will likely have to continue to wait and see how prices are impacted into the fall as it moves to accommodate the labor market.
Thank you all. Remember, the views and opinions expressed here today are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or ADM. If you'd like more information about our brokerage services, would like to speak to one of our experts about managing your risks, or would like to open a trading account, please visit www.admis.com.